Hello and welcome back to another video. Today I want to talk about the top 3 growth ETFs that you can invest in right now. So an ETF, if you guys do not know, is basically an exchange traded fund, and that's basically like an index of a variety of different stocks that make up a fund that's managed either passively or actively. So if it's passively, it's not managed by any human, it's just by itself, and if it's managed actively, then it is managed by a person every day. And basically, it's certain stocks which make up an industry. So, for example, like the ETF for the S&P 500 is basically all the stocks in the S&P 500, but you buy the ETF for that. So, for example, like VOO, which is a Vanguard stock, for that ETF, and you'd purchase, like, for example, one share of VOO is like around $250. But in that $250, it's basically you're paying a bit of every single company in that S&P 500. So your risk is spread out, and obviously the reward won't be as much, but the risk is spread out, and it's a good way to gain passive income if you can, like I've talked about in previous videos. So anyway, for growth ETFs, so this is, stocks which this is not related to dividends, but just solely on growth of the share price. I thought these three ETFs are very, very good. So the first one is Vanguard's VT, which is the entire world stock market. So this has been, the return has been very, very, very prudent, if you'd say. It's 5% return since the fund started, comparison to like the US stock market, which is 7%. This is basically an ETF for the whole world, like the whole world stock, right? So US stocks as well as foreign stocks. And basically, it's like if you think the world's going to develop over time, it's just invest in this. I think it's a very stable, risk-free purchase, in my opinion. I think it's good to have just because it's like, you can keep it in the sidelines and it's gonna grow. It's not like it's gonna go down, in my opinion. Like over time, it's gonna definitely it's gonna be slow growth, but there's gonna be growth. So you can invest on Vanguard, you can invest in whatever brokerage you have, and it says here it's the 4 risk potential, but that's really not the case. It's a lot more stable. So, but once again, do your own research and find what you like best. But this is a good thing to have in your portfolio. So the next one is gonna be QQQ. All right, so TQQ. I've talked about this before as well. I use it for day trading, but basically this is an ETF which follows the NASDAQ Index, and so the thing with this is that it's very technology dominated. And right now, technology is one of the primary sectors which is driving the economy. There's a lot of innovation in technology. You have Facebook, you have Apple, you have your Teslas, you have technology. All these companies that they're really driving the economy right now. And so the Nasdaq, it's an index. So the TQQ, it basically follows the Nasdaq. It's for it, and Nasdaq is very heavily oriented with technology-dominated stocks. So you have 100 companies you're invested in, but the sector is very dominated by technology. And so the thing you need to look out for with this is that sector dominance is usually cyclical or temporary, but it could boom now and it could stop today, even it could stop next year, whenever. But in my honest opinion, I don't think the technology sector is going to stop anytime soon. I think it's just getting started, actually. And the beta is 1.13, which makes it a bit more of a volatile stock to invest in. But I think it's a very good stock to invest in, just due to the fact that technology right now is booming, and I think it's going to continue to boom no matter. It might be some pullbacks, but at the end of the day, it's good to bet on technology. So the third and final one is ARK. So ARK Innovation, okay, it's an ETF, basically that is like the QQQ. It's like for the Nasdaq, but it's a lot more risk. It has a higher risk-reward ratio, and so it's one of its core holdings is Tesla, and as you know, Tesla's doing very, very well. So this is one thing to look out for. That the past year it's gained 65%, which is absolutely crazy in comparison to the normal stock market, which is 7%. For example, like the S&P 500, that's 7%. So this is absolutely crazy. The one thing to look out for also is that it's actively managed, meaning that there are people who run this ETF every day. And the thing is that data has significantly shown that people cannot outdo the stock market. For example, like the S&P 500, they cannot outdo it on a consistent basis. Traders have been behind like losing to the market for the past 9 years. So, this could happen now, but then say technology tends to die down, you don't know, and it doesn't do as well next year. So definitely watch out. But I mean, once again, if it does do well, then that it's going to do well, like by a big margin, that there's going to be a large margin of profit, because has a very, very high risk reward ratio. And so definitely check these three out. This is solely based on the growth of investment and the share price, not dividends, not passive income, but passive income as well, but solely based on the share price. So hope you guys enjoyed this. Leave a like, comment any other ETFs you guys think would be good for growth as a growth stock, and I'll see you all tomorrow.